Good evening, good afternoon. How's it going?
It's going good. A good Saturday afternoon.
Is it like an off day?
Yeah, it's like an off.
Nice. Hyderabad.
Yes, it's
Fantastic. So whether I was just doing your profile before starting the session.
Okay.
And I realized you have a crazy profile. You're a CFP. Correct me if I go wrong. You're a CFP. You're a CFA charter holder now.
I have to apply for charter, but I'm eligible now.
So you passed CFA level 3.
Yes.
And you're a ISB grad.
Yes.
And you're an ex-entrepreneur.
Yes.
And you're working in private equity.
Yes.
And how old are you? Is that an appropriate question to ask?
No, that's okay because I'm young. I'm 27.
Wow. And I think most of this you did like a few years ago.
Yes. ISB is a recent addition.
Is there anything that I'm missing on? I think you're also a dancer, right? You're a Bharatanatyam dancer?
Yes, correct.
Yeah.
Absolutely correct. Bharatanatyam.
And a lot of people at FinTree know you because of commuter notes.
All your credit. You just made me famous across FinTree students.
I mean, you deserve to be. So those people in the audience who do not know, at FinTree we have this product called commuter notes. It is some sort of audio notes, like a podcast maybe, where people can listen and study. And when we released them, like there were a lot of people in those notes, but Vaidai just became very popular. Like people started writing me messages asking you, Vaidai kaun hai? Who's Vaidai? So he's Vaidai for you. Great. Vaidai, thank you very much for doing this.
Sorry.
No, but thank you. We're going to have a lot of this today. Thank you very much for doing this. Here's the setup, so you'll understand what we're trying to do. This session is, a little bit of inspiration, little bit of know-how on all the future finance aspirants who are trying to build their career, right? And I'm sure there's going to be a lot of inspiration, lot of hacks that you'd be able to share in today's session. So we'll start first with what you're doing now. I understand that you're working in private equity. Yesterday we had a brief conversation. So tell us a little bit more about what you do. In fact, tell us a little bit more on what private equity is in the first place and what is your exact profile, and how does your day look like every day?
So talking about private equity, I work mostly for US based private equity. So I know more about private equity space in US because that's where my experience lies. But in general, private equity is more about startups who are looking to raise financing. And then there are people who have a lot of money and they would want to invest in various startups. So private equity kind of connects those investors to those startups. They take money from those investors. And so there is a limited partner, general partner. Limited partners are the people who would invest money. Correct me if I go wrong, because this is a part of CFA curriculum as well. And general partner is the one who would be responsible for making those investments in these startups. They do their own due diligence about the startup, whether it's worth investing, what would be the return if they invest now, what would be the return 10 years, what kind of an exit can they look after once they invest in that startup, whether it should be an IPO, and how they can. So it's not only about investing, but because it's a startup, the founders, co-founders may also lack some know-how about the operations, about marketing. So the private equity players are also expected to bring that know-how to that startup. So in the startup space or ecosystem, people will look not just for money, but also for some guidance from these angel investors or these private equity players, these venture capital firms. So that's about it. Now coming to my profile. I work in the post-deal space. So where once a deal is cracked, or for example, once the private equity invests in a few startups, they have their own funds. And then there comes the process where you have to track how those startups are performing. whether they are performing as on track, whether they are achieving their milestones, whether their valuation has actually increased from what we invested in, or has our valuation worth or declined, and overall. So it's not just done for one particular startup, it's done for all the startups in the fund. So my profile is essentially valuation for those private companies post investment has been done, and tracking those investments, whether they are performing. And then based on our valuation, the portfolio managers also get a guidance on whether this investment is going to be a successful exit or not, and whether it makes sense to exit it beforehand, like sell off in a secondary market, or whether to make further investments in that company or not, and if they should wait until 10 years, or they should exit it in between, whether 5 years, 7 years. So that's whole my profile. Talking about day to day, how we do it. First thing is, obviously, most of these companies will release their financials on a quarter-on-quarter basis. So that is our base tracking. But apart from that, we track news on various databases like Bloomberg, Crunchbase, PitchBook, about whether they're planning to raise any new fundings, at what price is that funding happening. If it's happening at a higher price, then what is the post-money valuation implied by that funding, and how much upside does that give to us, and whether the company really deserves it is another factor. Like, what are the factors that has led to the increase? Let's say it's a 4x increase in the prior round price. So Series A round was raised at $2, then Series B is being raised at $8, and that implies a post-money valuation of increase in post-money of, let's say, 3x. Then what has caused the increase of 3x? Does the real fundamental of the company have increased, or is it just a current boom in the market? And if it's a boom in the market, then obviously it doesn't, you can just foresee that you will not get a successful exit when there is a down in the market. So this sort of, and mostly it's all Excel based. We do all the financial modeling for these companies on an Excel, because most of them are early stage companies. If it's an extremely early stage companies which is not even generating revenues, then most likely we would go for a discounted cash flow model, because in that case you really can't use a comparable, because it's not always possible to get the exact comparable companies, and the company doesn't even have revenues to apply a multiple to it as of today. So in that case, we prefer to go for a discounted cash flow model. But if the company is generating revenue and it's kind of a late stage startup, let's say Series E financing, Series F financing, and is generating revenues of around $500 million to $600 million, then that would be definitely a comparable model, because you can expect the company to go public in, let's say, 2-3 years, and you will have some comparable comps, whose multiples you can use for valuing the company. So, yeah.
Right, let's slow down. I think that was more than what we could digest in one go. Let's break it down part by part.
Right.
What did you drink in the afternoon today?
I had a very healthy lunch.
Okay, step by step. So I think let's break it down. So private equity is basically private equity in a true sense. It's not venture capital. You are actually investing into more companies which have a clear revenue path.
Right.
Correct? Okay.
Right.
How large is the portfolio of your investor? Like, how many companies in the private equity portfolio?
So typical portfolios. I have worked for portfolios which have currently only 20 companies to a portfolio which had around 300 companies. So it also depends upon what is the size of your each investment. So the portfolio, which, it was a 300 companies portfolio, they did not invest a huge amount in one company itself. Only few companies where they had majority stake, but in most other companies, they had minority stake. Whereas in the portfolios, if now current private equity fund that I'm working for is more of a recognized fund. So they prefer to have majority holding in the companies, and so they prefer only 20 to 30 companies. And but I have not seen any specific size as such. It can be 20 to 30 to 300.
And how many of those companies do you work on? Do you work on all 20 of them, or typically at any point of time, how many companies are you working on?
So no, yes, if it's a private company, we work on all 20 of them, but it's not just one analyst. There are multiple analysts. So typical analyst will have around 10, 15 companies assigned to track. And we work for all multiple funds. So each of us would be tracking around 15 to 20 companies.
At any point of time?
Right.
So that's the 15 financial models to take care of.
Yes.
Correct. But then I'm guessing the work wouldn't be so heavy because you've already established valuation parameters. You just need to keep on updating it in most of the cases.
So, right, correct. The initial work is only when you have to build a model, a new model for the company. Once the model is built, then tracking that company is not very tedious job. But initial building the model and getting it right does become. But we can always see some scenarios like Russian war, which led to the turmoil in markets, and so then unnecessary the valuation was declined a lot for many of the companies, which were especially based on public comparables. So such cases the work becomes hectic, but otherwise, yeah, it's not.
Got it. Okay. And on an average, what's the revenue like of the? I'm sure it's a very broad mix, but on an average, what kind of revenue mix are you looking at? On an average, what's the revenue per company? Is it like $1 billion?
Right. So not $1 billion. $1 billion would be very rare, and then those are very near to the exit stage companies. So if a company has $1 billion revenue, mostly they would be looking at some sort of exit. But what I have seen, it ranges usually from $100 million to so it's in million, but 100 million to 500 million is very common trend that I have seen.
Right. Okay. And a typical investment size again varies depending on what yes. percentage you're buying, but anywhere in the ballpark range of 50 million to.
So if you're asking investment size in one company.
Yeah, one ticket size. Yeah.
Yeah. So one ticket size. So it also depends upon whether you want to be the lead investor. So the lead investor would invest the highest amount, which would be usually in the range of 20 to 30 million, or it would be typically around 50% of the whole financing round. So if it's going to be 100 million financing, then probably 50 million will be brought by that lead investor. And if you're not the lead investor, then the ticket size will be somewhere around $5 million to $10 million, $20 million. And another thing that I have noted is that, or at least from what I have seen, is people will not accumulate their stake immediately if they are not very familiar with the founders and all. They would invest in, if it's a Series A, then probably the investor would want to invest 5 million. Then Series B, if it thinks the company did well, then increases stake through Series B, Series C. That's a better way that I have seen, unless you are really very familiar with the investor, with the company owners, or the CFO or the CMO or CEO very well. That's what I have seen the trend that, and the ticket sizes that we work with are also somewhere in the range of $10 million, $5 million to $20 million. I've rarely seen a ticket size bigger than that.
Right. And I'm guessing the valuation that you're doing is more or less determining what size of check your investor is going to write in the next round, right? Is that, because I'm guessing your valuation is a function of your reporting service to the investors?
No, so it's not, right. So it's for the investors, right? And it essentially tracks the fund performance. So we do it for all the companies, and then how is the fund in general performing? And yes, then the investors would decide whether to further invest with different funds, because usually once a fund has, let's say, 100 million, then they would not want to bring in more money in that fund itself. They'll close the fund. But when they start a new fund, the investors would decide whether to put money for the same portfolio managers or not.
Right. So it's more like a, so for example, just to simplify and dumb it down, for people like me, let us say that I'm a private equity investor, not a fund manager, right?
Okay.
So some large private equity firm approaches me. They say that write $1 million check and you become an investor. So when you become an investor, you become a LP.
Right.
Then my money is called upon over a period of time. Money is deployed into different private companies. And then I would be getting some sort of a monthly or a quarterly report built by you guys, which will show the valuation of my investment. So I maybe parked in $1 million, and maybe in a year's time or a couple of years' time, it's 1.5 million, right? So you're responsible for doing the valuation and then sending those reports to the investors eventually.
Right.
Now, when these companies go in the market for subsequent rounds, is your valuation also a basis, or subsequent round valuation is your basis?
Subsequent round valuation is usually our basis. But then we also, if there is a huge difference, then we try to assess that whether it was on our part that we lacked some information about that company and that's why there's a huge difference. Or, is there a boom in general in the market and were we undervaluing the company? So we try to assess that gap, but it's most of the time that their valuation is our basis. Then we would do that valuation accordingly.
And how enjoyable is this work? Because I was doing a similar session with a venture capital fund manager some time back, and I asked him the same question. At VC stage, it's a lot more about idea. It's a lot more about promoter. It's substantially more qualitative. But as you move up the ladder and you start looking at private equity, is it substantially quantitative in approach? Is it more like numbers, or is there also a very strong qualitative approach involved?
So talking about my work, so I like my work because it's about financial modeling and I love to do financial modeling for any company, whether be it private company, public company, and understanding the dynamics. So from that perspective, I like it. But in private equity, I would say it's more about number crunching compared to venture capital, because these are late stage companies. They don't need so much of qualitative guidance. Probably they would need networking guidance in terms of going for IPO, for SPAC, and or there's something called a SPAC, which is going on in the US market. Right. Acquisition. It's kind of an acquisition which lets you be a public company. So that exit guidance is where these private equity players will be looking for. But in terms of generating revenues and establishing their business, that part is probably done. Most of it is done. When, especially if you are looking at a company which has raised, let's say, Series E or Series F financing, then that part is done where they have an established business model. They may be looking to expand laterally in different business verticals, but their core business is already established.
Right. So let's talk a little bit about this series. This is very fascinating. You said Series E or F. So you're almost at the IPO level when you reach that.
Yeah, you can say Series E or F.
Or does it go up to HIJK? Does it go up to Z?
So it depends what size were. Usually Series F can be fairly considered to be an IPO, but it's not. It's not a hard and fast rule. But it also depends upon what was the size of your previous rounds. If your Series A was just 5 million, Series B was just 20 million, and up to Series E you have just raised, let's say, only 100 million, versus a company who has raised 500 million until Series F, or 600, 700 million until Series F round, then they would be going. But it's not like, there are a lot of companies, I have seen companies with Series I round. Until Series I have seen Series G, Series H, Series G1. There's something called as bridge financing, where they want to go for IPO, but they still need financing in between today's period and until they go for an IPO. It's like 1 year where you have to do all the documentation and all the legal. So that bridge financing will also contribute to some series. So, but Series G, Series H is common, but typically we can fairly assume that Series F is kind of a late stage company.
Right. And can you dumb down the whole series business for us? I mean, someone who doesn't understand private equity space, it sounds all Chinese and Japanese. I mean, what does it mean in the first place? So start with your understanding of the entire ecosystem, right? So maybe starting point is what, friends and family, and maybe take us from there up to your series bridge financing.
So it's like when you start a company, initially you would put in your own capital to, a very seed capital, like it's kind of called a seed capital, where you would pull in money from your probably family and friends, very close family and friends, and you would start a business with, let's say, $10 million, or in Indian terms, 10 lakh rupees. If you want to start 10 lakh, 15 lakhs, then you think, okay, now I have established, I want to expand, but my network is not enough and I won't be able to get so much money. Then you would probably approach to some angel investors or outside investors who can guide you in that expansion, and they would also be willing to put in their own money. Now, when they put in their own money, they're going to obviously become owners of your company as well. So let's say currently you put only 10 lakh rupees and you need another 30 lakh rupees now to expand your business. And based on your 10 lakh, you work for, let's say, 4-5 years, your valuation based on revenues and everything, your valuation was around 50 lakh rupees. Now you are asking someone else to put another 30 lakhs, which is like kind of a 60% valuation of what currently is. So 50 lakhs, and so you are asking someone else to put 30 lakhs. So total post money valuation, now when that new money comes, 30 lakhs, that's called the overall post money valuation. But now here the negotiation happens as in, for that 30 lakhs, how much is the stake that you're going to give to your new investors? So let's say you're going to give a 10% stake in your company, 20% stake. So this is where, if you want to learn more about it, you could also look at Shark Tank India, which was started when they do all these negotiations, that we will give you 20%, 25% stake for so much of investment. And so actually, pardon me, I was wrong. If it's like, let's say you negotiated 30 lakhs for 20% stake, 1.5 is the implied valuation for your company. So, and when you bring in that 30 lakh rupees, now since they are going to be owners, they will definitely not go for common. The initial usual is preferred shares. So that's called series A preferred because they were the first one, or sometimes it's called series seed preferred as well. And these preferred have different rights and preferences. So usual rights and preferences would be like, let's say,
sorry, can I interrupt? I'm so sorry. Before you go there, because this is very interesting, but before I go there, I want clarity on the valuation front. Okay. So first thing is, let's say that I value a business, let us say for, so in fact, the way it would work, I guess, is that I need to raise 30 lakh rupees, 3 million.
Right.
Now I start negotiating on how much stake we are willing to offer. So let's say we do a 20% stake. So that gives me a valuation of 1.5. Now, so that's being calculated as 30 lakhs divided by 20%. And then I'm giving you 30. So therefore, I'm giving you 20% fraction ownership. Got it. Okay. After that, you were starting with something interesting. You're talking about preferred series.
Shares. So usually when this ownership is given to any investors, it's given in the form of preferred shares. The reason being because these preferred will have seniority over the common shares. So usually the owner himself will be having common when he invests. And then all the term sheet and everything. So there's something called as term sheet is drafted, in which you decide the rights and preferences of this investment. So typically series A, it looks something like, series A will have seniority over all the existing common stock and preferred, if there are any. And they would receive 1x of their liquidation preference. So all the rights and preferences are usually decided from a point of view that what happens if the company has to be liquidated. So it's like in the whole capital structure, first, in case of a liquidation, first will go to the debt, if there is any debt. And then among the equity itself, first will go to these preferred, and then it would be common. Now, another right And an extremely important preference that these preferred shares have is of conversion, that they can always convert their preferred shares to common. Now, this gives them an upside when the company goes public. So whenever they go public or whenever the valuation increases for the company beyond what they paid, and if they want to exit, then they can always convert their preferred shares into common. So it's kind of a win-win situation for any new investor who's coming in, that in case of a liquidation, if the value of the company falls, like let's say currently the valuation was 1.5 CR, it goes down to 1 CR, then you are still guaranteed your money because you have a right and preference which says that you will receive 1x of what you invested. But let's say the valuation increases to 3 CR, then and you want to sell your shares, then probably you can convert it to common and then sell the shares as well, because that gives you an upside. Because as common, you would receive more dividends, because all the profits go, if the company is distributing dividends, then you would receive dividends. Or it's kind of an exit scenario when you convert it to common. If you don't want any longer to be a holder of the company, you want an exit from the investment, you want to really earn your returns. So this is a typical right and preferences. So usually Series A is the first. Then as and when the company matures, they would raise next financing round, which would be Series B. The negotiation happens in the same way, like how much money do you need and what is the percentage of stake that you're willing to give to those investors. That would then again decide your post-money valuation, pre-money valuation. And as such, the company will go on raising rounds, and all these different series can have different rights and preferences. So let's say the late investors, Series F investors, because they would invest at a higher valuation, they can negotiate for seniority to all the existing preferred. So they can say that we will be senior to all the existing preferred. So in case of a liquidation, they would be the first ones to receive, then Series E, then Series D, then the rest of the preferred. And conversion rights would also be similar, like they can convert to common. So every preferred, I have not seen a preferred with or an article for the company where the preferred don't want to, or there are no conversion rights. Conversion rights will definitely exist, optional conversion for all these preferred. It can happen in a 1:1 ratio, or sometimes let's say seniority is not given to you, but then as a sweetener, sometimes they would give you higher conversion rate. So let's say you can convert for 2 common shares if you're holding 1 preferred share. So the conversion ratio becomes 2:1. So as such, your rights and preferences are negotiated. So there are a lot of combinations you can see. Sometimes if you are not given seniority, you may be given higher liquidation preference. Like instead of just 1x, you would receive 2x of your amount that you have invested.
I have some queries. I was wondering if I should interrupt or we'll let you finish.
Yeah, before I move on to
So okay. So let me again come back. All right, Vaidehi. So you're saying I wasn't aware that every deal is a preferred deal. I knew that the initial rounds were a preferred deal, but are you saying that every round generally happens as a preferred deal?
Yes, most of the rounds would happen as a preferred deal. Some of the rounds would happen as venture debt, wherein the debt holders, upon exit or upon hitting a certain valuation level, they can convert to the next preferred round shares, or they can convert to common, depending upon what kind of exit do they want. So I have seen convertible note raise or venture debt raise, wherein if it's a very early venture debt, usually the negotiation will be that whenever the next financing round is raised at a higher valuation, they'll have a valuation cap, let's say a $500 million valuation cap. So whenever new financing happens at a $500 million, the venture debt holders will automatically convert to the preferred, because they invested at lower valuation. That itself gives them an upside.
So more or less, the deals are happening either as preferred equity,
yes,
or they're happening as a venture debt.
Yes.
Right. So even in subsequent rounds. So for example, you're saying it's not surprising to see companies raise money through venture debt and maybe Series E, Series F as well. That happens.
Right. So in that cases, it mostly would be bridge financing. I mean, companies would want equity financing. That is what I understand. Most of the companies will prefer equity financing, whether it's preferred financing, preferred round, that is also fine with them. Preferred financing. Venture debt happens in the cases where company is not able to raise money through all the equity. So if they were looking for 100 million, but they could not raise 100 million equity, then probably whatever is the remaining part, they could go for venture debt, because obviously debt has a guaranteed return of interest in terms of interest or PIK, and they are senior to the equity holders, no matter which equity holders. So they would go for venture debt.
Right. So basically, one would go to venture debt if they're not able to close a round with equity funding. Primarily, that's how it will work. Okay.
Primarily.
And these preferred shares, will they also have a dividend rate, or there will be no dividend rates on them, like preference dividend?
Yeah. So dividend rates would be there, but most of the dividends that I have seen are something like as and when declared by the board. So it's not guaranteed. Like only if the board declares the dividend, then they are payable to those preferred holders. Otherwise, they are not payable.
So they're not fixed.
No, so they have a fixed rate of dividend at which it can be paid. But there are two types of dividends typically. One is cumulative and one is non-cumulative. So if it's non-cumulative, really it doesn't matter what is the dividend rate, because no matter what, your shares are not accumulating that dividend. So if the board doesn't declare dividend for this year, it's gone. It doesn't matter. Others are cumulative dividends, where right from the date of issue, your preferred starts accumulating dividends, whether the board declares it or not. They will accumulate, but they are payable only when the board declares those dividends. So let's say if the board doesn't declare it at all, they will still not be payable.
But isn't that the function of profitability? Like in case of preferred, because I was under the impression that if there is a profit, one needs to pay preferred dividends, or that's not the case?
No. So mainly for profitability, the preferred holders would look at the seniority in case if the valuation goes down. Otherwise, everybody, I mean, for what I have seen, everybody would look to convert it to common, because converting it to common and getting your shares at a higher valuation and able to exit at a higher valuation, that is the most
correct,
easier.
So you're not there for dividends. You're there for capital appreciation, right? Okay, got it. Fantastic. Tell us a little bit about term sheets. Like, is that supposed to be a legal document, or is just an informal thing that you sign?
Yeah. So term sheet is something where you would decide at what valuation, how much money you are planning to raise. That will definitely should have who is the lead investor, how many investors have signed up, and what are the rights and preferences for that round being raised. But it's kind of an initial document, but it guarantees that, okay, you have some investors and you are able to raise a financing. But I have seen scenarios where a term sheet is signed for, let's say, 50 million, but the company was not able to raise 50 million. So it's not kind of an obligation that if you have signed a term sheet for 50 million, let's say the lead investor has put all in the money, but because the lead investor would, let's say, agree for 20 million, rest 30 million, you still have to attract investment. But so term sheet kind of becomes a marketing document as well to attract other investors, that, okay, we have a lead investor willing to invest so much. And, we are planning to raise 50 million out of this. And these are the rights and preferences, because the rights and preferences will be dominated by the lead investor in most of the cases.
Got it. So lead investor kind of decides the terms, and then everyone else more or less follows the suit, right? Okay, cool. All right. Let's talk a little bit about jobs now.
Actually, one thing I would like to cover.
Yeah, sure. Absolutely. Go ahead.
In terms of rights and preferences, because it's again an important one, which is participating. That these preferred shares also have an option to participate along with the common, which is a very interesting feature where you don't really. So there are two types of participation. I mean, first, let me explain what is participation. So you are a preferred. and you have, let's say, a liquidation right of 1x. But if the valuation of the company is higher than that, higher than to what common can also get. So they have paid you your liquidation preference, and there is still money left. You want to contribute to that money as well. That's where you would participate with those common. So you participate in the profits or in the higher valuation along with common shares. And then there are two types of participations here. One is capped, where you can participate only up to 2x of what you have paid, 1x of what you have paid, 3x of what you have paid. And then there is something called as uncapped participation. So it's like you really don't have to convert to common. It's a complete win-win situation, because you would get your liquidation preference, and then remaining, whatever the common gets, you will get everything equivalent to common. So this is another interesting feature, and which may be included in order to lure investors.
Yeah, very cool. Oh, I had not heard of it, but this will trigger only in case of liquidation, not in case of IPO, right? If IPO is your exit.
IPO, usually the IPO prospectus will again define how the converters will convert. But yeah, whatever I currently said is mostly in case of liquidation.
Right.
But I mean, a point here to note is that when you're valuing your shares, you would consider all of these rights and preferences. Like,
understood.
Unless and until the company doesn't go public, you are going to assume a scenario, this scenario itself, and you would do all the valuation based on this scenario. Yeah. That, these are my rights and preferences, and this is what I would entitle. So until exit, all these will take into account. But once an exit, usually IPO prospectus defines how your convertibles, conversion shares would convert. But they will definitely not disregard all these rights and preferences. They'll adjust your conversion ratio to common accordingly.
Yeah. Okay. Cool. Again, I'm just curious to ask here. If the way I used to think is that if there is a liquidation, anyways, it's not the most preferred route for most of the investors to exit. So will that uncapped really bring that kind of a premium? Because anyways, you're liquidating, that means you were not so successful with the operations.
So agreed, it will not bring that kind of, but let's say there is a scenario where you are at the top. I mean, what benefits is that you have been paid whatever you are paid as preferred, and whatever minuscule would be left for the common shareholders, you are still trying to take hold of that
part
as
of
well.
It. Yeah. Okay.
Part of it. So it may not be an upside, but it still gives you more profitability than what it would without.
Got it.
But yeah, definitely. I mean, liquidation is not a scenario where you would want the company to move.
Very cool. Okay. Jobs. Let's say, there's a 21-year-old kid listening to us today who wants to break into private equity space. How should the job be perceived? Like what you're doing today is probably a dream job for a lot of CFA aspirants or finance aspirants. So how should it be perceived? What is a typical day like? What are the salaries in general? Like how much people get paid? How do you get in? Where do you apply? What skills you need?
So from a job perspective, CFA is definitely valued in this industry, and it's valued a lot, probably more than, at least if you're going to work for out of India space, they'll value CFA more than an MBA. If you are a CFA charter holder, then they'll value you more compared to an MBA in
Good to know
India.
that.
Yes, that's the reality. And especially if you're not going to work for the front end, CFA is a win-win. I mean, I would recommend, and I do recommend CFA to anyone who wants to get into valuation. From a knowledge perspective also, because all of what we have discussed is covered in level, most of it is covered in level 2. It's just about getting that experience actually in job. If you want to get into this industry, there are a lot of jobs available through portals as well. And usually, so in India, the valuation industry is more like we would offer to do valuations for companies outside, because it's kind of an outsourcing business here for most of them, that they would want to outsource their valuation work to Indian professionals. So recently there has been a lot of boom. There are multiple companies who only provide valuation services to clients in US. There are also some asset management or fund houses which require valuation for their internal funds, internal private equity funds. If I had to name companies, a few of well-known companies would be Duff and Phelps, or recently they have changed it to Kroll. Then another one is Grant Thornton, which again have very good valuation openings. Apollo Management is another one. Deloitte, then all the big fours in India. All of them, they do not offer valuation services as such because their charges are very high, but they do audit. So there is another audit process of the valuation that we do. So all these big fours are known for doing audits for these valuations. So then they again hire valuation professionals itself, because doing audit is just like doing the same work, but done by another person. So there are a lot of job openings in big fours for valuation audit. They also have some engagements, but those would be for extremely big ticket sizes. They would not do for small private companies. Then another interesting aspect, which I think most of us in India might not know, even I did not know until I worked, was something called as 409A, which is a law which is a section in US, which requires you to prepare a valuation report in order to issue ESOPs. If you want to issue employee stock options, at what value should you issue? So the law in general is that you have to issue it at the money. So for that, you have to perform a valuation and arrive at a price at which you can issue ESOPs. So that is another extremely in boom, I would say, service that Indians are providing to most of the companies in US.
Interesting. Who is doing this business? 409A?
409A, all the big fours do it. Then there's this startup or a company called Nocraft Analytics. I'm sure if you have heard of it.
Bangalore.
They provide this, Nocraft Analytics. They provide these services to their clients. Even I'm assuming Duff and Phelps also does it. These are a few on the top of my mind. But yeah, big fours do it a lot. I know about Nocraft. Duff and Phelps, I know for sure does it. Apart from that, I'm not very much aware, but this is another upcoming industry that is done. So what I talked about was only, private company valuation, but when we as a whole say business valuations, some of it is done for accounting purposes as well, under IFRS 9 fair valuation. So in order to be compliant with that, which comes as a part of, so there's something called as purchase price allocation. When an M&A transaction happens,
correct,
at what valuation should all the intangibles be brought on the books of the companies? That is another valuation aspect, good to learn or something. I mean, maybe not everybody finds it interesting because it's more of an accounting, but it's a mix. It's somewhere in between accounting and valuation. That's again a good thing to know. There's in general, these are the other aspects of valuation, business valuation. When you call a whole profile, people would expect you to know purchase price allocation, or at least these terms: purchase price allocation, what is goodwill impairment, and how would you value a company for goodwill impairment purposes? How would you do in general business valuations for a private company? So yeah, these are the few things.
This broad umbrella of this area is called business valuation. We can call it as business valuation, and then private equity valuation is kind of a sub part of it. Okay, and dominated by big four and then few players here and there, right? That's roughly the umbrella. So how do you get in? Let's say I'm great at financial modeling. Okay, in class, I'm doing a class. I've learned financial modeling. I know how to analyze businesses, run DCFs, do RVs. I've drilled it down. So I've reached to a level where I really know my stuff well, but no experience. Will these companies take me if I start applying them?
Yes, definitely. I mean, if you're a level 2 candidate, you have cleared level 2, you can, one portal is Naukri.com. Definitely, there are a lot of options available on Naukri.com. People will reach out to you through Naukri.com, but you have to have the right keywords in your resume. That you know DCF valuation, you know relative valuation. If you don't, you have to know, have to have these keywords in your resume and your job search portals wherever you are putting, because these people are going to search based on these keywords only, that discounted cash flow, comparable company approach, or what is called relative valuation, in other words. But definitely you would get a job. Another approach I would say is to reach out to people on LinkedIn and see if there are any openings, because that is really helpful. I mean, I don't know, people maybe undermine the value of reaching out to people on LinkedIn with a note saying, hey, I'm looking for a job, or in general putting it on your status that I'm looking for a profile on these, or applying for jobs on LinkedIn profile as well. So people will reach out to you once you get active on LinkedIn. So I'm not saying it will happen immediately, probably because it's kind of social media marketing again. So it will take maybe a month, but you have to have patience and consistency in your approach. And once you become visible on LinkedIn or on Naukri.com, it will come to you. I mean, it's not rocket science. You will get a job after level 2 or level 3.
See, you make it sound easy. I mean, I remember you used to come to CFA. You hardly came for the class, by the way. You were not a good student. I told you this. You were an intelligent student, but you were not a sincere student. I used to come and sleep in the class. Come on.
I was sincere. You used to call me earlier to promote your mock test. So I was a sincere student.
But you make it sound easy, but I'm sure. So how does and by the way, how much do people get paid at the entry level? A fresher CFA level 2 financial modeling aata hai. How much are they looking at? Like ballpark range?
Right. So CFA, it would be somewhere in the range of, let's say, 5 lakhs to 10 lakhs. If you're a fresher,
that's fair.
And you have no prior experience in valuation, I would say 5 lakhs to 10 lakhs, depending upon which company are you applying to. If Big Fours will pay kind of well, then there are few companies which pay well, but otherwise 6 to 7 lakhs is the range that you can look for. That's
for a fresher.
Yeah, for a fresher.
And even engineers can apply, or does it have to be only commerce background?
No. So it doesn't matter what is your graduation. What matters is whether you have cleared. I mean, level 1, people will not be preferred. I can tell you that. Level 1, people will not be preferred. It's either level 2 cleared or level 3 cleared.
Okay.
Yeah. But CFA level 1, I mean, it would be hard to crack without any experience. If you have some kind of experience in financial modeling and level 1, then okay, definitely you can get in. But if you are a fresher with no experience and you have just cleared level 1, then it will be extremely hard. I mean, you have to have a really good recommendation, or I would say it's hard. Sugarcoating.
So how did you get in at this place? Was it through ISB campus or you applied off campus?
Also, no, this was off campus. I got it through my prior colleagues in Deloitte. So they referred me to my current profile.
When did you get in Deloitte? Last time we checked, you were in Ahmedabad, right?
No, I was working in Deloitte after that for a year.
Oh yeah, now I remember. Correct. Yeah, we spoke about it once. Right. Okay, so for you, it's been interesting journey, because I think you finished your level 2 or level 3, then you went to Ahmedabad to work in this private equity valuation, similar profile, right?
Yes.
And then you decided to get into ISB.
Right.
And then you went to Deloitte.
Yes.
And now you're at this place. So why you were already a CFA? And this is a question a lot of people, I mean, okay, you are not a CFA charter holder, so let's, protect ourselves from the ethics. But you had finished all your 3 levels. Why did you choose to get into an MBA in the first place?
So my idea of doing an MBA was it's not just about knowing your industry, also knowing about being aware about what's going on in other industries and other jobs. guidelines. And second is for the strong alumni network that these preschools offer. So, I mean, I was lucky to get an off-campus job through my private network. But believe me, I think the confidence that the ISB alumni network brings in me is tremendous. I mean, it's an experience only once you get into an ISB or any other B school, one can only experience it, the kind of people you meet, the kind of knowledge exchange that happens. I mean, and in general to understand all the operations perspective. So I didn't know how would a manufacturing company run, or what are the kind of decisions that would be made in a manufacturing company. I did not know what were the different roles in marketing, or what analytic tools are used in marketing, and how in depth is that. So in order to get a holistic view of a business, or of in any business in general, I wanted to do an MBA. And another second important aspect was to build my network. So yeah, these two were achieved by
You
ISB.
paid a lot of money to do this, right? ISB is not it's a very expensive MBA. It's probably, I think, the most expensive MBA in the country. Of course, it's a desired MBA as well.
Yes, it is. I wouldn't deny it.
And you still ended up getting a job off campus, and you're doing the same profile that you're doing before your MBA. Maybe you're a senior now. You're bossing people around. But in the hindsight, when you think about it, do you think it was a wise decision to go and do this MBA?
Yes, it was. I mean, because the kind of awareness I have now, I did not have that. Like, I did not know what were product management roles. I did not know what were, different marketing roles that are available in general, and how digital marketing is exactly done. What is, there is one thing where you hear words, and then there is another thing when you look at people doing those things actually. Also, I did not know website designing was so easy until I got into ISB.
Website
people
what?
might just pull around that, because coming from a finance background, I was not very tech savvy. I was not very good with technology. But then now, not that I'm very good with technology now, but at least I know that, okay, just because I am not good doesn't mean that it's something hard to do. For a tech person, it's an extremely easy job to do. So that kind of awareness, and in general, even within finance also, I would say, I got to learn about the FP&A profile, how it is exactly done, what is FP&A. Then I got to interact about a lot of people who had actually worked in venture capitals. I have now friends who are working in different venture capital firms in India. I have a network. If I want to switch into asset management, let's say any day, I at least have a network to fall back upon when I say that, okay, now from valuations, I want to switch to asset management, or I want to switch to front end. Could you please help me refer? I have that network. So for me, it was mainly about building that network, meeting diverse group of people. So ISB is known for its diversity, and I can vouch for it because it was not just dominated by engineers. We had artists, we had doctors, we had retired army officers in our batch. We had people who were economic graduates. We had people who had done prior MBA and then came for a second MBA because they wanted a brand name. So it's a diverse group. So, when a doctor wants to do an MBA, you would like to know, why do you want to do an MBA? It's okay, we all want to do an MBA. Yeah, so it's an experience in itself.
Got it. Okay. And I think you once mentioned to me you had this young Indian something, right? That some sort of a fellowship that let you get into ISB. You knew in advance that you were going to ISB.
Yeah. It's called Young Leaders Program.
Young Leaders,
if you
okay.
are in final year of your graduation, you can apply. They'll give you an admit, and you can go to ISB after you complete 20 months of experience. I mean, it's like having an admit, but you need to complete the required amount of work experience, and then get into ISB.
And did you write GMAT for getting into this Young Leaders Program?
No, so I did not get through Young Leaders Program. I got through, there's another called as early entry option, where if you have less than 2 years of experience, you can still apply, give you a deferred admission. And that's how I got.
And does
into
it still
ISB.
need
So
a GMAT score?
Yes. Everything still needs a GMAT score.
Even young leaders, need it.
So for young leaders, the first stage of application doesn't need, but once you're shortlisted after first stage, for the second stage, you do need a GMAT score.
And what kind of GMAT scores are we looking at? Is it like
710 is the average median?
How much?
700
out of what? 760?
out of 800.
800.
So it's 90th percentile, 91st percentile is the median. So usually those people are admitted.
So 710 ballpark and fantastic profile. That's the recipe to get into ISB. Okay, cool. All right. I think I've asked most of the questions I wanted to ask. Tell us, what are you thinking? Where do you see yourself in a few years? Is this what you want to do and keep on doing it? Or do you want to explore some other areas?
Yeah, so
entrepreneurship maybe.
I know you're very much behind me to become an entrepreneur, but before I do that, I would, I think I'm looking somewhere at asset management, maybe either, for public companies or private companies, but asset management for HNIs, for closed funds, not maybe for the mutual funds in India, what we look at, but maybe for closed fund asset management profile is one that I am looking to. Otherwise, I don't mind continuing in this profile as well.
So you're not very keen on front office. You don't want to see clients day on day basis. No.
It's a stressful job kind of.
All right, got it. Let's take a few audience questions here. I think we have a few people who are attending the session today. So if you guys want to ask any questions, feel free to put them on the chat box. Bob is asking a question. He's saying, she talks about $1 million here and $100 million there. Is there a place for small investors too in private equity investing?
Oh, honestly, no. They have minimum ticket sizes decided, and it is usually in $1 million. So I'm not lying.
No, but Bob is not a small investor. I know Bob is a super. By the way, we do have a doctor who's listening us today. He's a surgeon. And so you were saying that you met doctors and you were curious why they're doing MBA. We have a lot of doctors. We have doctors like Bob who are doing CFA with us. All right then. So thank you very much. I really, really, really appreciate you doing this. And all right then. Thank you.
Yes, thank you. It was an honor to be invited.